Understanding the New Zealand tax system, a guide for full-time employees. If you're a full-time employee in New Zealand, understanding how the tax system works is essential for managing your finances effectively. While taxes might seem complicated, New Zealand's tax system is relatively straightforward compared to other countries. Let's break down how it works and ways you can legally minimise your tax and provide some thoughts on the fairness of the system compared to similar nations. How tax works in New Zealand. Firstly, income tax is the primary tax that affects full-time employees. Here's a basic breakdown. 1. Pay as you earn, or PAYE. If you're a full-time employee, your employer deducts income tax directly from your salary or wages through the PAYE system. The amount deducted depends on your income level and tax code. 2. Tax rates. New Zealand uses a progressive tax rate system, meaning the more you earn, the higher the percentage of tax you pay on your income. As of the latest data, have a look on screen at what you might be paying for your tax. Number 3, ACC levy. In addition to income tax, there's also an Accident Compensation Corporation levy, which is a small percentage of your income to cover the cost of New Zealand's no-fault accident insurance scheme. This is also deducted by your employer. Number 4, tax codes. Your tax code helps your employer calculate the correct amount of PAYE. It's important to ensure you're on the right tax code, as being on the wrong one could mean you're paying too much or too little tax. Ways to minimise your tax legally. While paying tax is unavoidable, there are legal ways to minimise your tax liability. Here are some strategies. Number 1, KiwiSaver contributions. Contributing to KiwiSaver, New Zealand's voluntary savings retirement scheme, not only helps you save for retirement, but it also provides tax benefits. Contributions are taken out before tax, and the government matches your contributions up to a certain amount annually. Claiming work-related expenses. If you incur expenses directly related to your job that aren't reimbursed by your employer, you may be able to claim these as tax deductions. For example, if you use your own vehicle for work purposes, you may be able to claim a portion of your vehicle's expenses. Donations. Donations to approved charities can be claimed as a tax credit, reducing the amount of tax you need to pay. You can claim 33.3% tax credit for donations over $5. Investment income. If you have investments, consider investing in a portfolio investment entity or a PI fund, such as certain managed funds. PIs have different tax rules and can be more tax efficient compared to other investments. Check your tax code. Ensure you're on the correct tax code. If you're working more than one job, you'll need to use a secondary tax code for the additional income. Checking your tax code regularly can help avoid overpayment. They don't pay you back. Rental property losses. If you own rental property and it incurs a loss, you may be able to offset that loss against your other income, reducing your overall tax bill. The New Zealand tax system is designed to be straightforward and equitable, with the progressive income tax structures that ensures higher earners contribute more. While there are legal ways to minimise your tax liability, it's important to remember that taxes fund vital public services like healthcare, education and infrastructure. Overall, the New Zealand tax system is fair compared to similar countries, particularly in its simplicity and the absence of some of the taxes that other nations impose. However, like any system, it has its complexities and areas that could be improved to ensure greater fairness. Understanding how the tax system works and taking advantage of available tax benefits can help you make the most of your earnings while fulfilling your tax obligations.